Hi, today Karol, Garzón, and me, Cristian Santamaría, are going to present a report for Vernasa Consulting about the Malaysian bond. The objective for the presentation of this report is to provide a study on the issuance of bonds by the Malaysian government, considering different scenarios to be delivered to the Minister of Finance of Malaysia. In each of these scenarios, the Malaysian bonds have an issue value of 1,000 monetary units, a coupon interest rate of 5%, and the risk premium is evaluated against the German bond, varying only the market interest rate, which in the first scenario is 5%. In the second scenario is 2%, and in the third one is 12%. In other words, in the first scenario, the Malaysian bond is trading at a par. For the second scenario, is trading above the par, and for the last scenario, is trading below the par. The methodology used for these calculations was to make the analysis and then calculate the variables before the analysis. First of all, the amortization balance for the year, the market interest rate for each year, calculate the cash flows, calculate the present value of the bond, then calculate the future value of the bond, and then the risk premium of the bond. After doing the pertinent calculations, the three scenarios were proposed to be able to make the respective analysis and to be able to see the economic panorama of Malaysia and evaluate its possible risk for foreign investment. Now we're going to talk about the scenarios. For the first scenario, the Malaysian bond is trading at a par. It means that it has the same interest rate for the coupon and for the market. So its issue value, it's equal to the present value, while its future value, it's 1,215.5 monetary units and has a risk premium of 300 basis points. This indicates that Malaysia's economy performance has not changed, and therefore there's no reduction or increase in fiscal responsibility or monetary policies. So it has remained unchanged over time.
From the first to the second scenario, the coupon doesn't change, but the market interest rate falls from 5% to 2%, for which the bond will trade above par, opening a gap. This may be due to a lower risk because it is believed that the issuer will be able to fulfill its obligation after the government corrects the fiscal deficit, improving the perception of the investor. In addition to the fact that the level of indebtedness is falling and they returned the level of investment to the Malaysian economy. Science, there is a direct relationship between the market interest, the future value, and the risk premium. As the value of the market interest rate falls, the future value falls from 1,215 to 1,160. And the premium of risk goes from 300 basic points to 0, while the present value maintains an inverse relationship with the market interest rate, so that when the second falls, the first increase from 1,000 to 1,072. In the third scenario, the coupon doesn't change either, but the market interest rate increases to 12%. It means that the bond is trading below par, so that what increased is its fiscal deficit, and investors have a bad perception and therefore they don't believe that it will be able to meet its obligation, leading to a loss of risk rating. This means that in the eyes of foreign investors, it is now more risky to invest in Malaysia. The direct relationship between the market interest rate, the future value, and the risk premium implies that the increase in the market interest rate generates an increase in the future value to 1,352, and the risk premium goes to 1,000 basic points, while the present value having an inverse relationship is now 859.